Our FMN crew was on hand at the recent Financial Executive International's Current Financial Reporting Issues Conference and captured a high-level panel discussion on the new lease accounting standard. The panelists offered a review of the new rules as well as discussed some practical implications of adopting the standard. The moderator was John Bober, Managing Director and Global Technical Controller with General Electric Company, and panelists included Scott Muir, Practice Fellow with the Financial Accounting Standards Board, Henry Reese, Technical Director with the International Accounting Standards Board, and Betty Davis, Partner, Financial Accounting Advisory Services Group with Ernst & Young.
Over the next hour, we're going to try and give you an overview of where the standard is now. I think there's often some misconceptions about where the standard is versus where it was when the last ED was put out, but it will be at a very high level. Henry and Scott will cover that. Betty is going to discuss some of the practical implications of adopting the standard, and we're going to have some open discussion as well. One thing I'd like to do before we lead off, though, is that there is the standard disclaimer that these are the views of the individual speakers and not the views of their organizations. So with that, let me turn it over to Scott and Henry.
Thanks, John, and thank you for doing my caveat for me, though I was hoping I was grandfathered from the last session. One of the final decisions that was reached as part of the overall final cost-benefit analysis was on the effective date. The ISB had previously decided that the effective date would be January 1st, 2019 for entities reporting under IFRS. The FASB decided similarly. In our typical way, we said for periods beginning after December 15th, 2018, but for ease of discussion, effectively we have the same effective date of 2019. In the U.S., however, private companies will be given an additional year deferral, just as they were for revenue recognition, meaning that private companies will begin applying the standards in calendar 2020. Broadly, what is the lessee accounting model? That's of course where the biggest change is going to be. You know, what's the big ticket item? Leases, the assets and liabilities that arise from leases will now actually be recognized on the balance sheet. What this slide highlights is each of the board's respective models for accomplishing that. And I think it is worthwhile to note the elephant in the room is that we do not have the same lessee accounting models. The FASB has decided that, similar to today, there will be finance leases, which are basically everything that you consider to be capital leases today, and operating leases, which is basically the same population of leases that are operating leases today. And they will have different accounting in the income statement and the statement of cash flows consistent with what you do today, which I'll talk a little bit more about in the next slide. However, the key distinction is that operating leases will be recognized on the balance sheet where they are not today. Conversely, IFRS 16 will account for all leases in the manner of finance leases, or in the way that capital leases are today. Well, I don't think we should gloss over the fact that we are not converged in this respect. And I think it is worthwhile to just spend a couple minutes, and I'd be happy to let Henry lend his perspective about why that is, given that initially that was one of the goals of the project, was to issue a converged standard. From my perspective, what I have seen over the course of the last few years that I've been involved in the project is that each board got significantly different feedback from people such as in this room. The feedback from preparers in the United States was very different from the feedback that preparers in the international community provided. In some respects, the international community considered lease classification to be a task of complexity that would be best eliminated. Most U.S. participants said, we kind of know what to do here, it's not a problem, and importantly, that classification regime and the results it yields in our profit and loss aligns with U.S. tax and, in many cases, regulatory reporting, such that retaining this distinction between operating and finance leases is important to us not having to have dual systems for our tax and regulatory reporting. If the principal goal is to get these leases on the balance sheet, this is the most cost-effective way in the U.S. to do that. Fairly, on the ISB side, they were told that, you know, the biggest thing they could do to help, and we'll talk about this later, is to take out some of the high-volume, low-dollar leases that don't particularly matter to the financial statements. And of course, when you're looking at how the ISB thinks about things, they can't be concerned with individual country, you know, tax and regulatory requirements because they operate in 100+ jurisdictions. So unlike the consideration that the FASB took about what would keep a useful alignment to tax and regulatory reporting, the ISB can't look at the same thing that way. So it was this real difference in feedback that was received from our constituents that has been, at least in my view, the principal driver as to why we've ended up with different models that do all, importantly, recognize the assets and liabilities from all leases on the balance sheet. Anything to add, Henry?
Not really, Scott. I mean, just to say, I think it is that element of receiving different feedback, and you've got two separate boards, and they have to weigh that feedback up for their respective circumstances. I think the ISB also very clearly heard that there wasn't a united view amongst their stakeholders also how to do lessee accounting. So ultimately, they took the view to do the model that, based on all the feedback that they'd heard from their stakeholders, that they thought would be most useful to the broadest array of users. But ultimately, that was the decision based on the feedback that we heard. I think it's just really important to emphasize, though, that although there is this difference between ultimately the presentation of the lease expenses and the cash flows between the two boards in the upcoming standard, but we are converged on what is the central aspect of the standard and one of the key goals here, which is to get all leases onto the balance sheet and improve the visibility and the transparency about the leverage. And ultimately, if you have a portfolio of leases, then I think the difference is not going to be so much on the bottom line of the income statement, but ultimately what the difference will play out is more in terms of a presentation difference between the ISB's standard and the FASB standard. Just a few words about disclosure. Consistent with other standards, both the new Topic 842 and IFRS 16 will include an overall disclosure objective. I think this is something that the two boards have found useful to help frame the subsequent disclosure requirements and also to provide some assistance to companies sort of in making their judgments about what disclosure should be provided. And as highlighted here, and I think consistent with other standards, specifying that companies should consider the level of detail required. And so, bluntly, I guess what we're saying is if leasing is more material to your entity, it's significant to your entity, we would expect more disclosures than when leasing is not a significant aspect of your activities. In terms of the lessee disclosures, both standards have some specific quantitative disclosure requirements, and these just cover the things that the boards have heard from investors that they want to see disclosed. There are some differences between the two standards, but I think those largely come from the fact that the lessee models are slightly different. A lessee is also required to provide information about some of the more judgmental areas. So this will be things around the existence of options in the contract and also the existence of variable lease payments. And the two standards have just approached these disclosure requirements a little bit differently, but the objective is still the same, which is to get information about these more subjective areas, judgmental areas in the lease contracts. In terms of the lessor disclosures, Scott was really explaining how fundamentally the boards think that the lessor accounting model is not broken, and therefore we're not fundamentally readdressing it with a new standard. But one of the things that we are trying to do with the new standards is really improve some of the disclosure around lessor accounting in response to what we've heard from investors. And in particular, we're seeking to get more information about a lessor's exposure to residual asset risk. And so what we're really trying to do here is allow users to, if you like, better understand how the risks split between the credit risk on the lease contract and effectively the residual asset risk remaining on the underlying asset. So I think that's some of the key things about disclosures. And lastly, just a few words about transition. And really what I'd perhaps focus on here mostly is the most significant aspect of these transition requirements in both standards, which is the requirements to leases that were previously classified as operating leases by a lessee, and how do we get these leases onto the balance sheet. And there are some differences here between the two standards. Looking at the FASB requirements first of all, basically the new standard will require a lessee to apply what's called a modified retrospective approach. And under this, the former operating leases are capitalised at the beginning of the earliest comparative period presented, but using some measurement reliefs and optional practical expedients. So under this approach, the lessee effectively measures the lease liability on transition by looking at the remaining rental payments that were previously reported under the previous standard, and then the right of use asset measurement is based on that lease liability. The ISB standard will actually permit a choice between two approaches. Firstly, a lessee could apply a full retrospective transition approach. Alternatively, a lessee could apply what we call a cumulative effect approach, and this is pretty similar to what's in the revenue recognition standard. And basically this would mean not restating the comparatives and instead recognising a cumulative effect adjustment. There are, however, some important practical expedients here to help on transition and really reduce some of the cost and complexity. And I guess two of the main ones are, in the FASB standard, really relate to grandfathering, both the identification of a lease. So for leases that were determined to be leases under current GAAP and services that were determined to be services under current GAAP, those don't need to be reassessed. And effectively, the new requirements only need to apply to new contracts entered into after the effective date. And similarly, the classification between operating lease and finance leases carries forward into the new standard.
So in terms of when I am talking to clients now about the proposed guidance and all that's been said, what are the areas that we keep hearing that they are concerned about? Certainly the area of definition of a lease is one. That's actually an area where the guidance didn't change drastically from what it was in EITFO 108, and if we look at it comprehensively, likely less contracts than are there today would probably qualify as a lease. However, there is a transition package that one can choose to not reevaluate under the new guidance, whether you have a lease, as well as reevaluating lease classification and what your initial direct costs will be under the new guidance, because that has changed as well, that I think companies would like to probably avail themselves of. But that does assume that you had assessed your service, your supply, your power purchase arrangements, all those types of arrangements under current GAAP to determine whether they've been a lease. And my experience has been that, practically speaking, many companies could qualitatively assess that they have arrangements that they know involve the use of property, plant, and equipment, but given their term, they're very comfortable that they weren't on balance sheet capital leases and often didn't do it an exhaustive analysis to assess whether those are leases. Now that really matters. That's your off balance sheet switch. So you need to know either if you're going to avail yourself of that transition package, whether you had a lease under existing guidance or not. Then turning over to the new guidance, again, the sensitivity around definition of a lease, I think, just hits some industries versus others. It really pushes the emphasis on who has operating control. And in some situations, it's difficult to assess what are the important items around operating control, not repair and maintenance, but really what does that asset do? And, you know, sometimes that is shared. Sometimes parts of it are, you know, predetermined. So there are some areas in the guidance, and it might relate to bigger service contracts or even supply contracts, where I'm seeing companies struggle, even with additional guidance out there on examples, which I think is helpful, on whether some of their large contracts are in or out. So I'm sure there will be further discussion probably around that issue in particular. Multiple element arrangements. If you think about it, if I enter into an arrangement and it includes using property, plant, and equipment and other items, I am going to be incentivized as a lessee to have as small amount as possible be in the lease component, because that component goes on the balance sheet. And while I agree that there's probably plenty of clients that have a few printers and copiers, the trend I am seeing in printer copier, in telecommunications, in data processing are very large company-wide, all my locations in North America type arrangements that include, you will provide me, you know, the use of the fixed asset, you will provide me with the toner and the paper, you will provide me with software that tells, you know, where a particular print job should go. You will provide me installation, you will provide me training, and I will pay you just one fixed amount. That's just the trend. The pricing seems to be going to bundling, and the accounting, of course, is in the unbundling area. So while one of those might not be material, a large one might be material, and certainly there needs to be some exercise to make that determination, and companies are concerned about how quickly they as a lessee can get the, you know, required information they need to separate their components. Likely in the printer copier example, they can probably find some good independent evidence. We'll need to set up some accounting policies and procedures, probably not so tough. In some other industries that might be more technical oriented, that might be a little bit more difficult. So there's a lot of concern around that area. Probably also what I hear a lot about is the concern ultimately regarding real estate leases, because just about everyone is involved as a lessee in a real estate lease, some in a large way, others less so, that depending upon whether you have a net lease or a gross lease with fixed payments, what you put on your balance sheet could differ substantially, especially if you have a longer lease term. So some of those details are the concerns I hear pretty consistently around lessee issues. On the lessor side, I certainly understand that we're keeping operating and finance, which is operating and capital, big picture-wise. Again, industry specific, I think some people are going to be surprised on some of the details. You know, because of revenue recognition alignment, we no longer are going to have special rules for real estate. So we don't have, if land value is 25% or more of land and building, we know we have a land operating lease. That's not the case anymore. And there's no requirement that title transfer to have a sales type lease. There's not automatically, you know, nothing on my balance sheet for a land lease that might have substantially all the payments, or the payments substantially equal all of the fair value of the asset. You could have effectively a finance lease of land that we don't have under current GAAP. So there probably are some follow-on implications in that area. Probably some other areas I see is that people don't think about is if a lessee sells a lessor an asset and leases it back, if he has a failed sale leaseback, there's a purchase option or some other item that causes him to fail sale accounting, under current GAAP, that doesn't impact the lessor. Under new GAAP, the lessor will effectively have a note receivable. He has a financing as well. So then he will also need to consider, what is my impairment guidance? I now have a receivable instead of I would have owned an asset. So there's kind of carry-on implications. What if I sell those receivables? Are they financial assets? Are they non-financial assets? So a lot of kind of day two things to think about that currently lessors, I think, may have not really been paying attention too much to the leases standard that for some might impact. One other area for lessors, those that enter into leases that they use residual value insurance in order to qualify for a sales type lease, they're no longer going to be able to recognize that gain up front. That gain will be deferred if they had to purchase residual value insurance. Now that's true under US GAAP. I don't believe that's true under IFRS. So a little bit of a difference on that point. Another area in the lessor accounting that I think might have less of a significant financial statement impact, but might have a system process impact is the definition of initial direct cost has narrowed. It's, incremental costs that are incurred as a result of doing that transaction. So if you, for instance, are paying attorney's fees to negotiate a lease document, whether that transaction gets done or not, I think you're going to be paying your attorney. Those aren't considered incremental costs. So those would be expense. They would not be considered initial direct cost as they might be today. Likely things like sales commissions that are paid once the transaction are closed are the types of items that are going to go into initial direct cost. Many banks, for instance, will often line up their portfolios of leases with their loan portfolios when they have finance leases, so on and so forth, that are now going to have to separate up. This is an initial direct cost of a lease transaction that might look very like a loan, especially for dollar out transactions, versus a loan transaction, are now going to have to make some policy changes, maybe some changes to their systems to deal with that kind of change. Those are the few just selected technical items I wanted to hit on. In the interest of time, I'm going to move to a little bit the practical implications. I can't emphasize enough that you really are going to need a multidisciplinary team. This is not just an accounting exercise. There's going to be assessments need to be made around when a lease term is reasonably assured to be exercised. There's going to need to be an ongoing maintenance of that view, simply because there is a reassessment. It's not easily reassessed in terms of a market change. Oops, I have to reassess. But it does require, typically lessee action, a new leasehold improvement or something of that nature. But often it's not somebody in the accounting department that knows about that and is making those decisions. So, in terms of the actual implementation of the rules, a lot of it is about accuracy and completeness of data and considering, system needs. It's not a lot of the technical points I just mentioned that will affect certain industries, but the overall implementation for companies that have a lot of transactions, it can be a practical task. When we go to clients, I think what we find is they're instantly jumping to, tell me what system I should use. I know I need them. I have lots of leases, and aren't often starting with, what do I have right now? And just about every meeting we go to, people sitting around the table from the client are learning that they didn't know a lot of the things that they did or didn't have. And especially if you're a global company, using that 5-year footnote disclosure isn't quite reliable enough of a starting point in a lot of cases. So really trying to get your arms around what you have now in order to then decide what budget and what time estimate am I going to need in the next 12 months to get started on this process. Then, of course, thinking about, am I going to need changes to my systems? What type of accounting policies am I going to need to adopt? Who's going to be the one that talks about real estate, equipment, so on and so forth. So again, I can't reiterate enough that need to get started as soon as you can, even without a final standard. There's a whole lot out there that both the boards have published. Yes, there will probably be some nuances that come out in the final, but certainly nothing that should stop anybody from moving forward. John?
Okay. Received a number of questions on the topic from the audience, and many of the questions related to the question of what is a lease versus what is a service, i.e., what's in scope, what's out of scope. The question of whether you have a lease rests often on the control of the asset. Many people were raising questions. Well, what does control mean in this context? Right now, we've got, for example, a notion of control through price, the capacity point, which is going away. But other than that, what is meant by control here in the context of the lease standard?
First.
Well, I think that the key thing to me really is saying that within the, if you like, the parameters of what your lease contract specifies as being your right, but effectively, I think it does really boil down to essentially is, do I have the right to make decisions about how that asset is used in my operations? I think that's the key to it. So I think the standard refers to the how and for what purpose the asset is used. Do I have those rights to specify that? And then obviously, then do I get the economic benefits that flow from it? And so it's both of those aspects of control, I think, is what's embedded in the new requirements.
This is one area where there will be significant judgments that people will have to do over time. Betty, based on your experience, what's the best way for companies to go through and figure out which of their contracts should be within the scope of this project?
Well, as I mentioned earlier, you're thinking about some level of materiality, obviously, but contracts where you know that your service provider, your supplier, so on and so forth, is using assets in order to deliver the service or the supply or the output, and then thinking about what type of assets they are, where they're located, and whether you have specifically required them to use particular assets. One area I'm seeing actually a little bit more movement there is in the data storage space, because of security reasons, instead of maybe companies being able to say, we'll store this much data for you and move this much data for you, companies are getting a little bit more concerned about only my data's on this machine and nobody else's, and if you're not going to use this machine anymore, perhaps you need to destroy the hard drive. Those things are driving a little bit more in terms of one of the characteristics of whether something is a lease, is it being specified. You still have to go through this concept of economic benefit and who's operating, but a lot of times, depending upon the nature of that contract, you clearly can come to a conclusion where a lessee may be operating, other cases less so. So there are common contracts out there that I think one will need to go through an assessment that might not be apparent until you step through the steps. So it really is where either material amounts, quantity of smaller assets, or large pieces of equipment, or even real estate are being used, you're going to have to consider that.
Scott, several times when we've had this discussion of leases before here, we've somehow come to the question of the how does one deal with capitalization thresholds in the context of leasing? Because some people have looked at capitalization thresholds as a possibility of simplifying their adoption efforts. But there was always a question in the background, well, usually when you're thinking of capitalizing an asset, you pay for it with cash and you just expense the asset when you acquire it. But in leases, you have an asset and you have a liability. Has the board given any more thought to how companies would apply capitalization thresholds to leases?
Well, I think, to some extent, there is likely to be a statement in the forthcoming basis for conclusions that would tell you that the board, of course, considers a reasonable way to think about the capitalization of leases is similar to the way you think about, capitalization for PP&E. That, of course, applying a reasonable capitalization threshold would be no less appropriate here than it would be in the PP&E example, which I suspect virtually every person out in the audience today has some sort of policy that says I don't, capitalize my staplers and my pencils and other things that are less than X dollar. In the board's view, certainly a reasonable starting point is thinking about what you do for property, plant, and equipment at that level. I think the board has been hesitant, and I would say rightly so, and I certainly don't have any additional insight from them to specify what we think those capitalization thresholds should be in relation to your PP&E threshold. Therefore, I don't know whether, as people begin to look at this, they might conclude that they can use a threshold that is bigger than what they use from PP&E, or smaller because this has a liability effect. Maybe the liability somehow changes how it would affect certain key ratios that you have to think about. That is not something where the board has, to this point, and we're done, where they have decided they're going to tell you what they think that should be. They merely acknowledge that the concept that exists in current GAAP and other areas is certainly not unacceptable thinking about leases going forward.
Betty, many areas of the proposals have been designed to dovetail with existing requirements, especially elements related to lease term and many aspects of lease payments. But what are some of the significant things that people should be thinking about here, even though the words may try and mimic what exists today in GAAP?
Yes, I think a couple things along that line. I mean, I think the boards have been very good with staying aligned on the key issues in terms of definition of a lease, what's the lease term, what are the fixed payments, variable payments. But the change for U.S. GAAP reporters from our bright line 75% or 90% test already still is eliciting questions, even with the discussion of changing the words in U.S. GAAP to, instead of reasonably assured lease term, reasonably certain. Again, the boards have been pretty vocal that we're not trying to change in concept where we are under today's GAAP and determining lease classification that's relevant in particular for the income statement. At the same time, I have to say that I see a lot of current transactions out there that are structured with 90% for the lessor and 89.9% for the lessee. So if we're moving off a bright line, how comfortable are we with 89 and 90? Probably less comfortable than we were yesterday.
That's very helpful. We're almost out of time, so I think it's probably best at this stage to thank our panelists for their efforts this morning, and thank you for coming.